Hey everybody, Randall Corneyer. Hope you guys are having a great day. I wanted to make a quick video on what the S3, what AMC withdrawing from the S3 filing means, and my take on it, as well as some other smart apes takes on it as well. There's been a lot of really great people putting their heads together on what this all means, and I think that we have a pretty accurate depiction of kind of what we're looking at here. So basically, yesterday, which was the 29th of June, AMC did file to withdraw from this S3 filing. So what is an S3 filing? And the most simple way to put it, it's when a company like AMC wants to offer shares to a private bank, institution, broker, hedge fund, for, I guess, and the best way to put it is they could do it for any reason. The why is really not so important. It's just a very general document. But specific to the AMC filing, they offered these shares as what's known as senior convertible notes. So a senior convertible note is a debt security, which is collateral, if that's the best way to put it, which allows the holder of that note to convert the note into a predefined amount of shares. It's basically a system where AMC can get cash in exchange for guaranteeing a bank a certain amount of shares that can be converted before a certain maturity date, or for cash after the maturity date. So after the maturity date at the end of the loan, it can be turned into cash. But if they decide to, almost like you would exercise an option, but to act on that note beforehand, it could be turned into shares. So in the filing, as of September 30th of 2018, AMC had $5.4 billion of total debt, which 1.6 billion of it was actually secured debt, and 315.3 million would have been available for borrowing as additional secured debt under the senior secured credit facility. The notes are effectively subordinated to the existing and future liabilities of non-guarantor subsidiaries. So essentially, this was an offering by AMC to issue shares to the banks or whoever they're loaning out this collateral to. The way it works is AMC receives a preferred interest loan from the bank, so they are paying interest on the loan that they're getting, in exchange for an agreed transfer of share ownership in the form of debt notes. The notes don't receive any form of voting power, but instead are simply just a fiscal device. The banks can convert these notes into shares at any time and do whatever they want with them before the maturity date. And AMC is going to be paying an interest rate of 2.95% in exchange for the ability to have the cash for loaning out that collateral. The shares that the bank holds in this situation at the end of this sell back to AMC in exchange for the debt. And that's basically how it works. The most important part of this is that AMC sold the notes to the bank at the deal of $52 at a $1,000 principal amount of the notes at a conversion price of $18.95. This roughly amounts to $1 million. At the maturity date of September 15th, 2024, which is the date that AMC would have to make good on this loan, the notes would reach their full value of 150% returns, and they're redeemable for cash. What's important to realize is that debt notes can't be shorted. So those securities, those notes, if they were to convert them into shares before the maturity date, technically they could short those shares. The banks could loan those shares out. They could be used a lot of different ways. So the document that I have in front of you guys right now is basically the plan of distribution. And if you look, you can see at the bottom, so short sales. So this is basically a way that what they can, these are a list of what they can use these shares for. And if you could see, short sales are transactions to cover short sales relating to the securities, one or more exchanges or over-the-counter market transactions, privately negotiated transactions, and the writing of options, whether the options are listed on the options exchange or otherwise. Okay? So banks can lend these notes as shares because they are convertible debt obligations. So there's no rules that says that they can't do that. And an interesting point that somebody on Reddit had mentioned, that if you had seen The Big Short, you'll recall the CDOs, which was when he was using the Jenga board So he was basically, you'll recall that collateralized debt obligations, which are CDOs, were the cause of the 2008 housing crisis because a massive amount of CDOs, which are very similar to convertible debt notes, lost their value when the mortgages of homes fell through, and the debt securities lost their value to all the mortgages going into default. For those that didn't, a CDO is a bundle. So if you didn't know if you haven't seen that movie and don't have an understanding of what it is, a CDO is a bundle of mortgage-backed securities or bonds, right, which base their value on the mortgage's debt. These CDOs grow in value as mortgages mature and are paid off. If a mortgage goes into default, it becomes worthless because people cannot pay their obligations. If most of the mortgages go into default, the CDO becomes worthless. And the same way that CDOs work, senior convertible notes work the same way. Banks have the ability to use these notes that they have, that AMC has given them, as shares. And as long as they hold onto the notes, they're the owner of the shares. So what banks usually do, though, they double dip, and they're smart to maximize their profits on the debt. So what they do is they take the notes and they turn them into, quote, lendable shares. And since they are the actual owner of the shares, they're the legal holder, right? They do essentially own the shares. So they can loan these out if they want to. They can collect interest on loaning the shares out, which is what we see when we look at, the shares available to borrow, etc. All those can be included in there. And so it's something that's actually actively being used against us. It's AMC's debt was being used against us. And so it's important to realize that. So the banks won't sell the shares, though, because they want to hold on to them for the maturity period. So the only real option is what they do, and this is how they double dip. They're not going to sell the shares out and go put them on the market, because they want to come at the end, like the September date, when these debts basically mature. They want to be able to make profit on that end as well. So what happens is, again, you have banks that can lend out the shares, which can be sold short to the market, right? These not borrowed shares, but they, I guess technically they are borrowed shares, because they are going to try and, AMC is going to want those shares back, right? But for the time being, they can short sell those shares in the market, and they have the ability to call them back too. If AMC were to say, hey, you know what, we have the money, we want to make good on our debt, we want our shares back. So the banks or whoever has that collateral, those notes, can also pull them back from the market the same way. So what did AMC do when they were withdrawing from this filing, right? Basically, in the most simple way to put it, AMC is buying back the debts from the bank. AMC was able to sell shares, which we've seen earlier, which a lot of people were upset about, which was the dilution, right? But they were able to secure some cash, right? So they sold the 8 million, and then I think, what was the other amount? It was, they sold, I want to say, they sold 8 million and then 11.5 million, which is the Mudrick stuff that we've seen, right? So all of that, it circles back. It's really interesting. So they made a bunch of money. They took that cash and they basically paid back this debt by withdrawing from this deal. So they are not in need of any more additional shares. To understand what all of this is worth and how many shares are at stake, we need to look at perhaps the prospectus. So let's pull up this sheet here. So let me zoom this in for you guys so you could actually see it a little bit better. So what we're not going to pay attention to the interest rate so much as 2.95%, because the debt's really not a factor anymore, because they withdrew from this already. But what we can see is that, AMC took the 34 million shares that's in this amount to be registered, right? And they got, in exchange for that, they got 600 million in cash. So they put up 34,285,000 shares. In exchange, they got $600 million in cash. So AMC sold 8 million shares in the market on the first round of their dilution to receive $230 million in cash. And that was a quick way to raise some money. And then with another 11.5 million shares, AMC was able to raise $587 million. So in two cases of dilution, which we were really upset about, The first case, they were able to raise 230 million in cash, and the second one, they were able to earn 587 million dollars in cash, which is actually 97% of their total debt obligation, right? So AMC was able to take, by doing this, by selling the dilution originally, AMC was able to buy back all their debt and pull them out of the market, right? So they sold the shares, they diluted, they covered these bonds, they withdrawed from this statement, and now they're pulling those 34 million shares that you see in this sheet. Because they covered this, those 34 million shares are being brought back to AMC, right? So AMC now has those 34 million shares. And again, those 34 million shares were out at banks that were lending them out to short us, okay? So it's very interesting. So AMC did something that to me, is incredibly bullish, and in my opinion, erases any negative thoughts that we had about previous dilution, because they pulled the shares out of the market that were being used to attack us and short us. 34 million shares no longer can be used to hurt us, damage the company, and it puts the shares right back into AMC's hands. And if you ask me, this is a very high-level play by Aron. This is some smart shit. Like, this is something that I think that when everybody else is playing checkers, this man's playing chess. It really has the idea that, to me, it means the dilution that we've seen is just literally erased off the books. And, that's 34 million shares that no longer can be used to attack us, right? And these banks, like I said, they're not our friends. And so what's important to this, about this, like I said, is that Aron, and I've been an advocate of him, and I think some of you guys might agree or disagree, but this is a very simple way. I think this is really cut and dry, like a white and black for me. Like, there is no way that this is not a good thing for us. The banks no longer have 34 million shares. The company was able to pay off its debt with its original dilution, and also screw over the short sellers, banks that were attacking us. So, with that being said, I think that we're in a great spot. I think this was a power move. And, AMC is doing things that are ultimately helping us and helping the squeeze. So I hope that gives you guys a better breakdown of what we're looking at and what's been going on. And I hope this was a more simple understanding for you. There's been a lot of people that have put this information together. I didn't know a whole lot about, convertible, bonds and all these different things, right? So it's important that, and I want to highlight this, how critical it is that we're in a group where information can collectively be talked about and dissected quickly. I mean, this document came out yesterday when we were on TMI stream, and, us with the chat and like 6 other people, Twitter, Reddit. I mean, we just jumped into action to figure out like what this means. And so myself, guys, I'm very bullish. I think this is a good thing. I think this is a power play by Aron. And I'm excited to see what this brings. But he is on our side, and I'm happy to see what the future holds. So with that being said, I hope you guys enjoy the content. If you do, please like, subscribe, and I will catch you on the next one. Love you long time. Peace.